Three stocks, the March 2019 edition. Let's get started. What's up, everybody? My name is Ala and welcome to my world of stocks. I know you guys like timestamps. I left them for you down below in the comment section. All I ask is that you hit the like button if you enjoyed the video, as it really helps the channel survive and grow. Now, in case you're new to the channel, this is a series where I talk about 3 different stocks every month and I try to give a long-term kind of bullish thesis on them. But I'm not anybody's personal stock picker, so please always do your own research and make your own decisions. It's not easy to do this every single month and looking at different stocks and things like that. This is just somewhere to start, and maybe if you find these stocks interesting, then maybe you can research them further if they appeal to you. Alright guys, but starting with stock number 1, that's going to be Take-Two Interactive Software, ticker symbol TTWO, and this is a gaming stock. And the reason why I'm looking at gaming stocks right now is because they've really been taking a beating lately. Now, a lot of this started with Electronic Arts, which started crashing sometime last year and has since lost around 50% of its value. And that really happened for several reasons, but their management was just really all over the place, from pushing loot boxes and microtransactions that gamers hate more than anything, to their CCO telling their fan base not to purchase their newest Battlefield game because they felt that EA was pushing a sort of social agenda. And while I don't have any opinion on that particular issue myself, I think that their CCO telling gamers not to buy the game was one of the dumbest things I've ever seen management of any company do, as it led to pre-order sales coming in 85% lower than their rival game in Call of Duty from Activision Blizzard. Although to be fair, they've now seen a pretty nice rally, especially this past month, thanks to a new free-to-download game called Apex Legends that some analysts are predicting will give Fortnite a run for its money, given that it's now gained over 10 million players in just the first 3 days since launch and has already clocked in over 25 million. Of course, the other stock that got destroyed was Activision Blizzard, which I actually do own a position in, and that stock tanked by pretty close to 50% from their all-time high. And this was also due to several reasons, but again, management added to all of the negativity by announcing a mobile game at a PC event where literally nobody cared about mobile games, and when the audience questioned why this was only coming to mobile phones instead of PC or even consoles, the speakers just responded with an even more aggravating response, asking the audience, "You do have mobile phones, right?" And of course that led to a PR nightmare, as Activision was already being heavily criticized for microtransactions as well. Needless to say, gaming stocks are not in a good place right now in terms of brand or customer loyalty, so I've been staying away from any new investments in the sector. Having said that, sometimes an abundance of negativity in the market can lead to more attractive valuations. And while several of these stocks still trade at fairly high prices, I have to admit that I do find Take-Two interesting because they have tremendous future potential despite getting hammered in the short term. See, despite being up close to 400% in the past 5 years, the stock is now down over 33% from their 52-week high of close to $140 per share to now trading in the low 90s. And when looking at the reasons for the drop, well, aside from the entire industry selling off, Take-Two's guidance for their next quarter was around $555 million in sales, while Wall Street wanted to see over $600 million. And that seems to have upset investors, as it may be a result of their newest flagship game in Red Dead Redemption 2 seeing a slowdown in sales. But by all other accounts, that game was still a pretty big success, at least in its launch quarter, where it sold over 23 million copies and was the highest selling game of 2018. And even though guidance was weaker than expected, the reported quarter was still outstanding, as revenue jumped by almost 160% year over year to a massive $1.24 billion, and net income jumped by over 600% year over year to almost $180 million, which helped them beat expectations, as their EPS surprise for the quarter was almost 60%. Not to mention that the 3 quarters before that were 23%, 140%, and 18% respectively, all of which is very impressive. And if that wasn't enough, net operating cash flow increased by over 60% in the last 3 quarters combined year over year, while adjusted operating cash flow increased by over 187%. And these hundreds of millions of dollars are helping to strengthen an already decent balance sheet that consists of almost $1.3 billion in cash, almost $3 billion in current assets, and over $4.3 billion in total assets, with zero long-term debt and only around $2 billion in current liabilities and $2.3 billion in total liabilities. So they are pretty well positioned to make any future investments or acquisitions to fuel future growth if they need to. Not to mention that Take-Two still owns a number of other highly popular games like BioShock, Borderlands, NBA 2K, which, by the way, NBA 2K has been the highest selling sports title in the last 3 years in a row, and they're even releasing a mobile version of the game, which is an important play on the mobile gaming industry that is growing faster than both console or PC gaming. And they also have 2 of the top 100 grossing mobile games in Dragon City and Monster Legends, and of course, who can forget Grand Theft Auto, which is one of the best-selling game titles of all time. In fact, if we look at the best sellers list, we can see that their newest entry, which was GTA 5, has already sold over 100 million copies and is the 3rd best-selling game of all time, only behind Tetris and Minecraft. Even GTA San Andreas and GTA 4 both reached the top 25 list as well. And given that GTA 5 launched back in 2013, we may be close to seeing another iteration of the game in the next 2 or 3 years, which could be a major growth catalyst that may reward any long-term minded investors. But despite all of this success, the stock is still being treated very badly in recent months, and a lot of analysts are pointing to the Fortnite effect as a cause, where free-to-play games like Fortnite and Apex Legends are seeing a lot of success in that they get downloaded by a ton of people and then generate continuous revenue through microtransactions. But I think that investors are forgetting that Take-Two is a master of microtransactions, which is evident in the fact that almost a quarter of their sales come from recurrent consumer spending, which is just a fancy way of saying microtransactions or virtual currency spending. Things that are heavily implemented into GTA Online, Red Dead Online, and NBA 2K Online. I actually played GTA 5 myself, and when I was playing the online version, I literally couldn't get anywhere in the damn game because there was just so many microtransactions and you had to pay for anything that you wanted to do. Still, when looking at their valuation, it isn't as cheap as I'd like it to be, with a market cap that is still above their enterprise value and a trailing PE of almost 30. However, thanks to their growth, they have a much better forward PE of just 18 and a PEG of less than 1. But for me personally, this is one of those stocks that I really wouldn't mind waiting for the perfect price. Like, I know that the stock is down a lot already, but with all the recent market volatility and with so many people screaming for a crash and a recession, I really think that this stock could go lower just because I don't really see any big hit titles coming out between now and when that next Grand Theft Auto game comes out. I know that they were talking about in their conference call that there is an unannounced big title game coming out in 2020, but I really don't think that's going to be Grand Theft Auto. They usually take a long time in development for that franchise because it's a very popular game and they polish it very well. They always do a really good job, which is a good thing, but I just don't think it's going to be coming out anytime soon. It's probably going to be like at least 2 or 3 years, I'm thinking. It's just my opinion because I haven't heard any rumors about it being in development. But if that's the case, I'd rather just kind of wait to see if the stock does get dragged down lower and then maybe pick it up at an even lower price. And then when that Grand Theft Auto game comes out, I think a lot of investors would flood into the stock just because of all of the hype. But anyway, that's how I feel about Take-Two. I'm just tracking it right now. If the price does get a lot more attractive, then I might consider a long-term position. But right now I really think the future is going to be dependent on that next Grand Theft Auto game. However, the next stock number 2, is the complete opposite. I've actually been buying this stock heavily. I've been buying it at under $30 per share. And this is, the stock is AT&T, ticker symbol T. And again, I've been doing all of my buying at under $30 per share, and that's where I feel the most comfortable buying any more shares because my dividend yield on the stock is currently over 7%, thanks to my really low cost basis, but because of a recent rebound, the price per share is now above $30 and the yield has dropped to around 6.7%. But even at this yield, it remains an amazing dividend as they have now increased that dividend every single year for the past 34 years, and I highly doubt that they'd be willing to cut it anytime soon and ruin that enormous growth history, even if we go through a recession, which makes the stock much easier to hold long term. By the way, ignore that negative 5-year growth history on Seeking Alpha. They sometimes glitch out when they make that calculation, but it's probably somewhere around 2 or maybe 3%, which is still pretty low, but at least the yield is already very high, and there are other things that are also interesting me about the stock anyway. For one, their valuation is very cheap thanks to poor performance. In fact, even if we look as far back as 5 years, they are still down by over 8%, but on the bright side, this means that I get a much cheaper stock that sports a market cap that is almost half of what their enterprise value is and has a trailing PE of just 10 and an even better forward PE of just 8. Even their PEG, PS, and PB ratios are all reasonable as well and not too far away from 1. And the other thing that I like is that they stand to benefit heavily from 5G technologies that many analysts are predicting will bring much needed growth to the telecom industry, as well as provide the fast speeds required for megatrend markets like autonomous driving with connected car features and the Internet of Things. And yet another reason is that while the stock has been beaten down due to legacy parts of their business like landline telecom and cable TV that is hurting from the whole cord cutting movement, their recent acquisition of Time Warner gives them the firepower content that they'll need to launch their new streaming service that will compete with the likes of Netflix, Amazon, and even Disney. See, this gave them the rights to a host of entertainment content from Turner, Warner Brothers, and even HBO. And this includes content from popular networks like Cartoon Network, TNT, CNN, TBS, and production from Warner Brothers Pictures, New Line Cinema, Castle Rock, and the list goes on. By the way, Disney is launching their own service with Marvel content, so it's kind of cool that AT&T will have theirs with content from the DC universe to compete. And while Marvel has seen much more blockbuster success lately, there is still a lot of potential in the DC universe if AT&T can turn things around. You're talking about IPs like Batman, Superman, Wonder Woman, The Flash, and so on. Those aren't some small names in the superhero world, and they should attract an audience if, again, AT&T can market them correctly. And results are already looking pretty good as revenues for their last quarter jumped by around 15% year over year thanks to the acquisition, and over 6% for 2018 on a non-comparable basis and around 9% on a comparable basis, with over $22 billion in free cash flow to help them reduce debt and maintain their sweet dividend. I know this isn't enormous growth by any stretch of the imagination, but you have to keep in mind that they recently went through 7 straight quarters of negative revenue growth, so any positive growth is a good sign. So when I look at AT&T, I really see a company that is in a transitional phase right now, and sometimes that's the best time to buy stocks, at least in my opinion, because you get to pick up a company, a stock that has been beaten down because of what happened in the past, and they're transitioning, they're investing in future growth, which should hopefully reward you in the future. At least in my case, I'm being patient with this stock because it has such a high dividend. My dividend yield on my cost basis is above 7%, and that's a really nice dividend yield. Really nice reward for holding on to the stock long term and just kind of being patient and sitting back and waiting for these growth catalysts to come in the future, with 5G technologies and their upcoming streaming service. So anyway, right now, I personally really like AT&T and I'm investing heavily in it. Okay, now moving on to stock number 3, that's going to be Facebook, ticker symbol FB. Now, I did actually just talk about Facebook just a few days ago, so I apologize if you already saw that video, but I really wanted to include it in this one as well because Facebook is really growing on me. Now, if you want to check out that other video, I did a full analysis on Facebook. You can find it in the description, and I went into a lot more detail, but I'm just going to cover some of the main points why Facebook stock is growing on me. And keep in mind that Facebook is a stock that I never really invested in long-term myself. I did do a short-term play on it once, but it's not really a stock that I ever believed in too much. But my opinion is really changing now. And the more that I think about it, the more that I'm researching the stock, the more that it's becoming much, much more attractive to me because of what they're doing already and what their future potential is looking like. Now, they are currently down over 25% from their 52-week high, and they sport a forward PE ratio of just around 18. Although to be fair, they are trading a bit higher than their enterprise value, and some of their other metrics are more on the premium side of the spectrum. But I don't really see that as much of a problem since you're still getting a very strong company in return. In fact, they currently have over 2.3 billion monthly active users on their Facebook platform alone. And despite that number already being enormously high, it actually grew by around 9% year over year in their latest quarter. And if we lump that in with total users using at least one of their platforms, those being either Facebook, Instagram, WhatsApp, or Messenger, the number climbs to an amazing 2.7 billion monthly users. For context, that's about 35% of the world's total population. That's insane. And that access to an enormous amount of people has led to some very strong earnings. In fact, Facebook saw their sales climb by 30% year over year in their last quarter and 37% for the full year of 2018, bringing in over $55 billion of revenue. And so you might be asking, well, why then is the stock struggling? Well, that has a lot to do with their data security issues that started with the whole Cambridge Analytica scandal, where the political consultant accessed personal data of over 87 million Facebook users, and this snowballed into horrible PR and legal issues when other security breaches surfaced throughout the year. But Facebook seems to be taking the necessary steps to restore users' confidence, as they have now increased their cost by over 60% in the last quarter, and their total headcount by a massive 42% in the fiscal year, as an ongoing effort to beef up security and prevent these issues from recurring. On the bright side, despite the heavy increase in spending, their operating income was still able to increase by 6% in the quarter and 23% in the year. And partly thanks to all of their share buybacks that they've been executing in an effort to return profits to shareholders, their EPS increased by 65% in the quarter and 40% in the year. And while these numbers already look phenomenal right now, I still believe that there is more future potential to be had. See, according to Statista, digital ad spending is estimated to be over $300 billion this year and increase to over $500 billion by 2023, with the largest amount of that spending being on social media advertising, which is exactly the market that Facebook dominates with all of those billions of users. Not to mention that over half of global digital ad revenue comes from mobile advertising alone, which is also the fastest segment of the market, and Facebook is already seeing the benefits of their mobile applications, as 93% of their advertising revenue comes from mobile, which is up from 87% the year prior. In other words, the majority of their revenue is coming from the highest growth segment of the overall market. On top of that, Facebook is making a lot of progress in the e-commerce market as well, with storefront pages and shoppable posts on their social media platforms. And even when you consider that Facebook's user growth is slowing down as it reaches all-time highs, you still have to remember that they own Instagram, which is one of the fastest growing social media platforms on the planet, as you can see on this chart here. Not to mention that they have an absolute beast of a balance sheet that can fund any future investments or acquisitions for future growth, with over $10 billion in cash, over $30 billion in marketable securities, over $50 billion in current assets, and almost $100 billion in total assets, with only around $7 billion in current liabilities and $13 billion in total liabilities. That monster of a balance sheet alone makes Facebook one of the most attractive stocks in the market. So even though I haven't pulled the trigger on Facebook stock yet, it is definitely one that I'm tracking very closely. And if we see another significant pullback, another significant, dip here in the short term, I can almost guarantee you that I'm going to pick up at least a few shares, probably, a small position, and then maybe add to it over the long term. But this is a stock that is just pretty incredible to me. Very strong balance sheet, such a big user base, and it's still growing. I mean, it's pretty incredible. And I just see a lot of future potential. Less digital advertising or less advertising spent being spent on television and newspapers. That's going to transition more and more to digital advertising spending, especially on social media platforms. And they just do it so well too. I mean, I don't know if you guys have seen, the shoppable posts on Instagram, but I feel like they always do a pretty good job. Like, it's always posts that kind of catch my attention, which means that they probably have a lot of data on me and they probably know what would kind of interest me. But they're doing a really good job. And I have to imagine that they probably have very good engagement rates as well on those shoppable posts on Instagram, which is probably going to attract more and more advertisers as well, which will make ad rates go up as well. But I think I'm rambling on now, so I'll just stop. Anyway, Facebook is a stock that I am very interested in at the moment. With all of that said, I think that's just gonna just about do it here for the video. I hope that you enjoyed it. If you did, make sure you hit the like button and leave me a comment down below. What do you think about these 3 stocks? I love reading your guys' opinions and comments and thoughts. So go ahead and leave a comment if you don't mind, and I will catch you guys in the next video. Take care. Bye-bye.